Understanding Investments, A Few Minutes at a Time by Daniel Dower. From Chapter 6, Value Investing, Issue Number 22, Mr. Market. In The Intelligent Investor, Benjamin Graham explains how to take advantage of price volatility. He wrote, quote, "Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply, and sell wisely when they advance a great deal. At other times he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies." Close quote. Graham relays this notion through the allegory of Mr. Market, an obliging fellow who turns up every day at the shareholder's door offering to buy or sell his shares at a different price. Often the price quoted by Mr. Market seems plausible, but sometimes it's ridiculous. The investor is free to either agree with his quoted price and trade with him or ignore him completely. Mr. Market doesn't mind, and he'll be back the following day to quote another price. On most days the price is reasonable and justified by the business's prospects. However, Mr. Market suffers from some rather incurable emotional problems. When Mr. Market is overcome by boundless optimism or bottomless pessimism, he will quote a price that, as Graham noted, quote, "seems to you a little short of silly." Close quote. One should not fall under Mr. Market's influence, but rather learn to take advantage of him. No matter what, he will arrive the next day to make another offer. An investor should not regard the whims of Mr. Market as the determining factor in valuing a company. An investor should determine the value of a stock rationally by concentrating on the operating performance of the company. He should profit from market folly rather than participate in it. Every day the stock market offers investors quotes on thousands of businesses, and we're free either to ignore or take advantage of those prices. Always remember that it is not Mr. Market's guidance we are interested in, but rather acquiring shares of companies that we choose at prices that we choose. Graham does not conclude from Mr. Market's behavior that market fluctuations should be completely ignored. They can be valuable as an indicator that something is going wrong with the investment. Successful investors make their own decisions based on their personal opinions of intrinsic value. They do not follow the market.